Welcome back to We Here Now. I'm X. Let's get to it. So, this is video number 2 in the trading doctrine, how markets actually move. So, most beginners think markets move because of indicators. They think of the RSI going up, price goes up. Or if the MACD crosses, the market will move. But that's not how markets work. Indicators don't move markets, people do. Every movement you see on a chart is the result of buyers and sellers exchanging shares. And if you don't understand this simple idea, charts will always feel confusing because they're truly not confusing at all. If you can see patterns, and I mean, if you can actually see patterns, this will be a breeze for you. So in this lesson, we're going to break down what actually moves markets, what liquidity really means, and why some markets move cleanly while others feel chaotic. All right. Um, Transitioning from video one, we were briefly talking about how markets actually move. So, in the previous lesson, we talked about what trading actually is. Trading is speculation on price movement using defined risk. But now we need to answer the obvious question: what causes price to move in the first place? Because if you misunderstand the engine behind price movement, you start believing indicators predict the market, and they don't. Indicators simply summarize price and has all that has already happened. So, in other words, indicators are lagging. All of them are lagging. All right. Buyers and sellers. Markets move because of supply and demand. Every trade requires two participants, a buyer and a seller. When buyers are more aggressive than sellers, price moves up. When sellers are more aggressive than buyers, price moves down. But here's something important: markets are not moved by small retail traders placing tiny orders. Yes, $1,000 is still a tiny order. The majority of price movement comes from large participants. These can include institutions, hedge funds, pension trade funds, large investors. These participants control enormous amounts of capital, and this is why I trade with those people, because if they are moving the market, I'd rather be on their side of the trade instead of retail. Here I go again, getting too advanced. So because of that, they can influence price when they enter or exit positions. But there's a problem. If a large fund wants to buy millions of shares of something, they can't just press a button and buy everything instantly. They would move the price too quickly. Instead, they need something called liquidity. Liquidity means how easily an asset can be bought or sold without dramatically moving price. High liquidity markets have many buyers and sellers. Low liquidity markets have fewer participants. This is why some markets move smoothly while others feel extremely volatile. When liquidity is high, price movements tends to be cleaner. When liquidity is low, price movements can become violent and unpredictable. This is why professional traders prefer trading large stocks, major indices, highly traded assets because they contain deep liquidity. Liquidity makes price movement more stable and more readable. For, for an example, if a stock has, only 10 participants, and it's $1,000 uh, market cap. If one of those 10 people put up $1,000, that price would move dramatically. But if there's 1,000 people and has, let's say $100,000 market cap, that $1,000 is not going to move much, if anything. Hopefully that makes sense to you guys. Hopefully that makes sense. All right. Why some markets look chaotic. Now think about markets that look messy or random. Often these markets have lower participation, basically what I was just saying. When fewer buyers and sellers exist, even small orders can push price dramatically. This creates what traders call whipsaws or fake moves. Price breaks one direction, then quickly reverses. This is extremely common in small stocks, illiquid markets, low volume environments. And beginners often beginners often mistake this randomness for opportunity. But but professionals recognize it as something else. They recognize it as risk. Here's that special word again, risk. So, if this, then that logic. So let's apply this to the decision thinking. If price moves violently with low volume, then be cautious. If a market has deep liquidity and consistent participation, then trends tend to cannot speak this morning. Then trends tend to develop more cleanly. If you see repeated fake breakouts, then the market may lack strong participation. This type of thinking helps traders avoid some of the most common traps. There's all types of traps in trading. Common beginner mistake. One of the biggest mistakes beginners make is assuming every price movement is meaningful. But many movements are simply noise created by temporary order imbalance. Professional focus on markets where participation is strong and consistent because when large capital enters the market or a market, the moves tend to be more structured. Understanding liquidity helps traders answer a very important question. Is this movement meaningful or is it just noise? Connect to charts. Now, here's where this becomes important. Everything we've just discussed today is recorded on price charts. Charts are simply a compressed history of transactions between buyers and sellers. Every candle on a chart represents a battle between supply and demand, which means if you learn to read charts correctly, you can actually see the footprints of participation. And that's exactly what we're going to learn in the next lesson. So, in the next video, we're going to break down something every trader must understand before placing a trade. How charts actually work. We'll cover candlesticks, open, high, low, close, and why time frames change how markets look. Because once you understand how charts record market activity, you'll start seeing patterns that beginners completely miss. So if you're serious about learning trading the right way, continue to the next lesson. All right, I'm X. You've been watching We Here Now. I'll see you guys to the next one. Peace.